A very happy new year to all of you, my dear friends and investors. I hope 2023 brings you a lot of health, happiness, and prosperity. Usually, this is the time of the year where most people tend to think about predictions. It's a new year, and everybody wants to try and understand what will happen in 2023 so that they can try and position or make decision based on certain predictions. But as we all know that making predictions is the most difficult aspect, and therefore we are not here going to make any predictions for 2023. However, we will and we must review what happened in 2022 and what are the implications, if any, as we get into the new year. And the context setting is very, very important, because every time there is a new narrative, there is so much of news flow around that we tend to forget the facts. We tend to ignore what the numbers are telling us. And sometimes looking at the facts and reflecting on them is a better guide to the future than trying to make predictions. So let's see what happened in 2022. After a great start, we immediately had a big geopolitical event, which was the Russian invasion of Ukraine, which led to higher energy prices, higher commodity prices, and disruptions in supply chain. And just when we thought we were getting out of COVID, these challenges hit us. And as we have spoken in the previous month, that this spike in commodity prices, inflation, supply chain issues because of the war led to an impact on EBITDA margins of a lot of companies and also led to a spike in global inflation. And therefore, the central banks were forced to start raising interest rates to bring inflation down. And as we wound down towards the end of the year, that wasn't the end of the story. We had a massive resurgence of COVID in China. There was again a fear that almost set in that are we going to get a third major wave of COVID, which has started in China. However, China has decided to reopen the economy irrespective of the COVID surge, and that has implications for what can happen in 2023. As we all know that the biggest stimulus you can give to any economy is to open it up. And China has been opened up after a long 3 years. And therefore, there is also a fear that if China opens up and consumption booms, then we may continue to see higher commodity prices, and therefore inflation may continue to remain reasonably high even in 2023. So we do not know, but I think this context is extremely important. If you look at the performance of most of the global markets in 2022, very clearly India stood out. The US was down 21%. Emerging markets as a whole were down 22%. Asia ex Japan was down 21%. and the Nifty just about eked out a positive return of 5%. Now we all know that while Nifty gave a moderate 5% return, the internals were quite different. And we've spoken about this in the past, that the breadth of the market wasn't that good despite the Nifty being where it is, because of the impact that commodity prices and inflation had on profitability. So if you then break down and see the trend of what happened to large caps, mid caps, and small caps, I think the story is very clear from the table that in 2022, the large caps outperformed. The mid caps kind of did okay. The index delivered a 3% positive return. But the small caps are the ones which really took a massive beating. The small caps were down minus 14%. And what is interesting is that if you look at this table where we put the returns every calendar year right from 2010 to 2022, one trend that emerges, which is very interesting, is that if you have a moderate single-digit return in Nifty or a negative return, the next year you typically have a solid double-digit returns. And this has happened quite often. So if you look at 2013, for example, you had a 7% return on the Nifty, but a negative 5 and negative 8% on mid and small caps. But the subsequent year, you had a 31% rise in Nifty and a 56 and a 55% rise in mid caps and small caps. Similarly, if you look at 2016, you had a 3% rise in Nifty and a 7 and a 2% in mid and small caps. But in 2017, you had a massive double-digit 29% growth in Nifty and a 47 and a 57% growth in mid and small caps. So the point I'm trying to make, again, I'm not trying to make a prediction, but if history and the trend were to be kept into account, there is a very high probability that after a very modest 5% return on the Nifty, you could have a solid double-digit return on the Nifty this year. And if that happens, then again going by the historical trend, you will have a very strong rebound in mid and small caps, right? And therefore, if the next 2 years, which is 23-24 and 24-25, if the Nifty is able to deliver a double-digit earnings growth, which we think there is a reasonably high probability, then I think the current gloom and the general sense of fear that we see in the markets may be completely misplaced. Now, from market cap, if we drill down to sectors in 2022, despite a 5% Nifty gain, the standout performers were banks, and within banks, especially the PSU banks, as we said last month, and the public sector units, which delivered a 23% net return. Auto and FMCG also did well, and so did metals. But the ones that fared very poorly were IT and pharma, sectors which had actually done well in the preceding years of COVID. So usually what you see is that the sectors that do extremely well may not necessarily do well the next year. And the sectors which don't perform may actually bounce back. right? Now, obviously, we can't take this as a 100% trend, but usually when you look at the year by year performance by sector, it does happen sometimes that the best performing sectors of the previous year may not necessarily be the best performing sectors in the subsequent years. But having said that, clearly 2022 belonged to banks and the PSUs. A big question that all investors are worried about and asking, which is that if the US goes into recession, will it have an impact on India? Now, we need a nuanced answer for something this, right? If you were to look at the World Bank and the IMF and a lot of other institutions which predict GDP growth, and if you look at the predictions for the major economies of the world, what stands out is that despite a recession in 2023, especially in Europe and as well as in the US, you will see India still delivering a 7% growth in 23 and a 6% plus growth in 24. And India will continue to lead GDP growth amongst all the leading countries in the world. And this is after taking into account a recession in the US. In the past, a positive GDP growth does not necessarily mean that markets will give you positive returns. But I think that when India stands out compared to all other countries over the next 2 years in terms of economic growth, why it's important is because that is one of the important considerations that foreigners will have when they want to invest in a country, right? Both as FDI and FII flows. So while the correlation between GDP growth and market returns are not necessarily correlated, but allocation of money is definitely impacted if India were to stand out over the next 2 years in terms of GDP growth. One of the most important macroeconomic factors that is talked about globally and feared is the rising interest rates because of inflation. And without getting too technical, if we were to look at real interest rates, and what is real interest rates? Is if you subtract the interest rates that you get, let's say, by buying a 10-year government bond, minus inflation, if you still get a positive return, which means that if you are a saver and if you were to put your money in fixed income, and if the fixed income return beats the inflation, then you have positive real rates. And it is important to have positive real rates in order to attract savings into the banking system, because even the government needs to borrow for deficits. It is also an indicator of how much more the central banks would have to raise interest rates. And if you look at the table that we've put out of all the economies in the world, you will see that there are certain countries like Brazil. In fact, Brazil was way ahead of the curve. They raised interest rates the quickest. Brazil has a positive real interest rates. India has now entering a positive real interest rate scenario. If you have one more, let us say a 25 basis point or a 50 basis point rate hike, I think we would be one of the few countries in the world which has a positive real interest rates. And therefore, we believe that RBI is not behind the curve. And if inflation in India were to soften, there would be no need for the Reserve Bank to raise rates very aggressively. And that's very important both from a growth perspective, but also from a P multiple or a valuation perspective. If we are pretty much reaching peak rates in India, by and large, that's good news for future potential returns. And then there was also the worry about FX reserves, which were depleting after reaching a peak somewhere in N21, because in 22 the Reserve Bank of India used almost $100 billion of FX reserves to protect the rupee. But now, in the last couple of months, we have started to see a revival in FX inflows as FIIs also started to pour money towards the end of the year in the equity markets. And therefore, whether we look at India's standout GDP growth, if we look at the fact that there is not much of a rate hike ahead of us, and the fact that India delivered a relatively strong equity market performance in 2022, we still believe that all the conditions, structural factors that are required for India to deliver and the equity markets to deliver a positive return are still in place. And therefore, we still believe that while there may be risks in the horizon of inflation, war still being there, of a recession in Europe and the US, we still believe that the structural factors that make India stand out aren't going away. We have lower corporate taxes. We've done supply side reforms to invigorate manufacturing through PLIs and a lot of incentives. We have a great opportunity in exports because of China plus one, Europe plus one. We believe that as government revenues have been reasonably strong and we are getting into an election cycle in 24, government capex will continue to be reasonably strong to support economic growth and also spending in rural areas. We do believe, as we have said in the previous few months, that finally private capex is picking up. We continue to see that the profit pools are moving from the unorganized to the organized sectors. Consumers continue to be confident. The country's financialization and digitalization continues unabated. We think rural sentiment is beginning to turn and is pointing towards a recovery. Corporate balance sheets have never been this healthy, and the bank balance sheets are also healthy with very low NPLs and a very strong credit growth. I think if we put all of this together, it all points to the fact that we have the necessary conditions to be able to withstand the uncertainties and the risks that may be on the horizon. And there isn't a need to excessively worry about what's happening in the environment. And despite all these macro factors that I mentioned, something that we've been mentioning for a long time, if you take September 19 to September 22, right, a 3-year period, your GDP in absolute terms has increased by 33%. But the operating revenue of non-BFSI companies, so let's say about 1150 odd companies, has increased by 41%. Operating profits have increased by 62%. And PAT has gone from 4 lakh crores to 7 lakh crores. If you include the banks this year, we will hit a 10 lakh crore figure, which means that profits have grown by 80% plus. And the ROE has improved from 12.5 to 15, and ROC has improved from 18.6 to 22.6. So the point I'm trying to make is that there has been a real positive momentum and change in the bottom-up numbers of corporate India with very strong balance sheets and a reasonably strong improvement in return ratios. And why I'm saying this is because people keep repeating that Indian markets are very expensive. And we have kept arguing that if you look at the absolute jump in corporate profitability, then the current market levels clearly justify it by hard numbers, right? And therefore, we reiterated that instead of getting lost in narratives, it is very important to look at the numbers and convince ourselves that we are on a strong wicket. And why shouldn't India's valuations be at a premium? Let me tell you that why do, for example, great quality companies trade at a premium? There has to be a very clear economic reason. They trade at a premium because of growth and because they have a strong balance sheet and they have strong return ratios and they have consistency. So if you have consistency, if you have growth, if you have a strong balance sheet, and if you have a great business which has a reasonably high rate of return or return on equity, then those companies definitely trade at a reasonable multiple. Now, if India was one stock, then all of this, what I said, is true. And therefore, we believe that with healthy balance sheets, with growing ROE, growing profitability, it is completely justifiable that the Indian markets trade at the multiples at which they are trading. If you look at the chart of the global valuation summary, India is trading at a peg of 1. And what is peg? Peg is the ratio of PE divided by growth. So it essentially tells you for every unit of growth, how much are you willing to pay? And paying a peg of 1 is not excessive. Yes, it's not cheap. A cheap peg would be if, let's say, growth is 20% and PE is 16, which means that you are paying less for every unit of growth. In India, it's 1:1, and it's not excessively expensive if you look at the forward PE multiple for FY24, the Indian markets are trading roughly at about 16.6 times, which is very reasonable given the quality of balance sheets and that relatively India will perform better than anybody else in the world. And therefore, in summary, the long-term structural factors for a bull market in India remain positive. Inflation seems to have peaked, may not fall immediately because of the China reopening, as I said, but it may not go up excessively as well. And if Indian corporate balance sheets stay healthy, And if India delivers double-digit earnings growth over the next 2 years, we do not believe the Indian markets are expensive. And it is quite possible that in 2023, we may have a reasonably good double-digit earnings on the Nifty, with the mid and small caps outperforming the large caps, unlike last year. So with this, I end this month's communication. I hope it was a little long, but I hope this perspective gave you enough confidence. And I look forward to 2023 with optimism, and we believe that we should be able to deliver reasonably strong return for all you investors. Thank you again. A happy new year once again to you and your family. Until next time.